Hello, Assalamualaikum. My name is HIZAMI bin Ahmad ZAINAL, and today I will be presenting about capital structure for corporate finance FIN 537. Okay, now what is the capital structure? The capital structure is the combination of the company's sources of finance that consists of debt and equity that can assist in funding investment and meeting the operation needs. Two main parts of a company capital structure are debt, which include borrowed funds, and equity, which represent ownership in the business. For a number of reasons, finding the ideal balance between these components is crucial. In addition to affecting the cost of capital, it can affect our company's valuation and risk exposure. Okay, analyzing an organization's risk tolerance and financial risk is crucial in choosing the right structure. A key component of financial management, capital structure, affect a company's capacity to raise capital for expansion, weather economic storms, and increase shareholder value. A business requires assets in order to manufacture and market its goods and services. For instance, a company that produces shirts, for example, need tools like irons, cutting boards, sewing machine, and other structure to keep its tool. Additionally, the business will require a certain raw supplies like thread, butters, and cloth, etc. These are assets that the business needs in order to run its activities. Okay, these assets are owned by the corporation. The capital of the business is represented by its funding sources. Capital may be broadly classified into two categories, equity and debt. We can assume that asset equal to liabilities plus equity, or asset equal to liabilities plus equity. The equation that we must understand in businesses. Okay. Business usually use debt and equity to fund their assets. Financial leverage is a term used to describe the debt that a company employs. A company's capital structure is the portion of debt to equity that it utilizes to finance its asset. Okay, when a company raises money from investors, do investors forego the opportunity to invest that money elsewhere? In economic terms, there is an opportunity cost to those who buy a company bonds or stock. Okay, let's say we want to buy a Tesla stock with 10,000 ringgit, for instance. We can see that Disney or Apple stock would have been a better option for us. Even though we had a lot of other options, we were out of money for anything else once we decide on a Tesla stock. If we could guarantee a larger return than we could for the same amount of risk on the investment, that is the only reason we will buy the Tesla stock. This means from Tesla point of view that the company can only draw our capital if it provides an expected return that is high enough for us to decide to invest in it. A company's cost to raise capital from investor is to provide a return that is comparable to what investors could expect to earn elsewhere for a comparable risk. Okay. Most businesses have several funding sources. The weighted average of the company's debt, and equity cost of capital represents its overall cost of capital. That is known, we call it as the weighted average cost of capital, WACC. The proportion of debt and equity utilized in the firm's capital structure are represented by the weights in the WACC. For example, if a company receives 25% of its financing from debt and 75% from equity, for instance, the weights in the WACC would be 25% for debt and 75% for equity cost of capital. We can make the equation like market value of assets equal to market value of debt plus market value of equity. It is important to remember that a company's debt and equity values are derived from its asset market value. Okay, so how to determine optimal capital structure? Optimal capital structure for a company involves finding the right combination of equity and debt financing to increase the firm value and lower the cost of capital. This balance considers the company's risk tolerance and financial objective. Striking the right balance allows the organization to take advantage of the benefits of both equity and debt financing while minimizing their disadvantages. By optimizing its structure, the company can decrease its financing costs. Managers typically try to work within a range of values because it can be challenging. They must also consider the signals that they send to market through the financing decision. In order to prevent dilution and any unfavorable signals to the market, a company with a strong prospect will attempt to raise capital rather than using equity. A practice known as debt signaling occurs when a company makes an announcement that generally interpreted as good news. An excessive amount of capital raised by a company in a given period of time will result in higher cost of debt, preferred stock and common equity, which will raise the marginal cost of capital as well. Potential equity investors consider a company's debt equity ratio when determining its level of risk. Additionally, they look at how much leverage other companies in the same industry are using in order to determine whether the company is using an unusually high level of debt in its capital structure, assuming that these companies are operating with an optimal capital structure. Okay, here are some factors that affect the capital structure of an organization. Okay, first, business risk and industry characteristic means that volatility-prone industry might choose to take on less debt in order to reduce financial risk. Second, financial performance and stability means that business that consistently earn profit and have strong cash flow are likely to be more able to meet their debt obligation. Okay. Third, cost of capital consideration. Excessive interest rate, tax implication and weighted average cost of capital (WACC) helps determine the most cost-effective mix of debt and financing options. Okay, number 4, market condition and investor sentiment. Prevailing market conditions impact equity and debt financing availability and the cost. Number 5, company size and life cycle stage. Startup and rapidly growing firm may rely more on equity to fund expansion, while mature companies might incorporate debt for stability and tax advantages. Okay, number 6, tax implication. Debt financing is appealing from a tax standpoint. because interest on debt is frequently deductible. Businesses evaluate the tax ramification of various funding choices in order to minimize their tax exposure. Number 7. Access to capital market. It might be simpler for businesses to raise money through the issue of stock if they have easy access to equity capital markets. Conversely, people who have access to good debt markets could use debt financing to obtain capital at a reasonable prices. Number 8. Regulatory environment. Compliance with regulatory requirements like debt agreements is essential for maintaining financial stability and market credibility. Okay, last one. Flexibility for future growth. A critical factor is a structure that allows for adaptability in responding to changing market condition, acquisition or strategic investment. Okay, and here are some considerations to guide for our decision-making process. First, risk assessment. By understanding the financial risk associated with different level of debt and equity is crucial in shaping an optimal structure. Second, cost of capital analysis. Evaluate the impact of interest rate and tax application on WACC to identify the most cost-effective combination of equity and debt. Number 3, industry norms and peer benchmarking. Comparison organization capital structure can be used to determine areas of potential optimization and access to competitiveness. Number 4, cash flow and earning stability. Business may be better able to service debt if their cash flow are steady and predictable. Conversely, individuals or company with varying income level might prefer equity financing in order to escape fixed interest commitment during hard times. Number 5, strategic objective. Think about whether keeping financial flexibility for strategic initiative is more important than rapid expansion. The business strategy ought to be reinforced and supported by the chosen structure. Number 6, market condition and economic outlook. Economic cycle and interest rate trends can impact the cost and availability of both equity and debt financing. Number 7, flexibility for future needs. An ideal framework should offer the essential flexibility to meet future capital needs, whether for organic growth or seizing market opportunities. Okay, last one, regulatory compliance. Adhering to legal obligation and maintaining good governance instill confidence among investors and creditors. Okay, now we go to financial distress. A business that is in financial distress is one that is unable to meet or pay its debt because it is not generating enough revenue or income. High fixed costs, a significant amount of illiquid asset or revenue that is susceptible to downturns in the economy are typically the cause of this. Ignoring financial distress before it spirals out of control can have disastrous consequences. When a company debt becomes too great to pay back, there may come a point at which there is no longer any way to escape extreme financial hardship. Bankruptcy might be our only option if this occurs. Okay, now we go to understanding financial distress. If a company experiences a period of time when it cannot pay its debt, bill and other obligations by their due date, they are likely experience financial distress. A firm's expenses that must be paid include financing costs such as interest on debt, opportunity cost of project and unproductive employees. Employees of a struggling firm may experience lower morale and increased stress due to risk of bankruptcy, potentially leading to a job loss. Obtain a new financing may be challenging for companies in a financial distress, and the market value of firm may decline significantly as customers reduce order and supply chain term. Okay, sign of financial distress. A company shows signs of financial distress like a various warning signal indicating trouble ahead. Inadequate profit could indicate financial stability, while consistently struggle to make ends meet suggests that a business is unable to sustain itself without seeking external funding. This can elevate the business risk and diminish its creditworthiness with lenders, suppliers, investors, and financial institutions. Next, decreasing sales or sluggish sales expansion suggests that there is limited demand for a company's product or services under their current business model. If costly marketing efforts fail to generate growth, it may indicate that consumers are no longer content with what is being offered, and potentially leading to the company shutting down. Cash flow may be seriously strained if debtors take an excessively long time to pay off their obligation to the business. It is possible for the company to be unable to cover its own debt. When a business only has one or two significant clients, the risk is significantly increased. And now, how to remedy the financial distress? Turning things around and finding solutions for financial distress may seem daunting, but there are strategies that can help. One common approach is for companies to reassess their business plan, examining both operation and market performance. It is important to establish a clear timeline for achieving all financial goals. Identifying cost-cutting areas is another factor. A company's bottom line may suffer if staffing levels are lowered or management incentives are reduced. Restructuring debt is a possibility for certain companies in order to increase their liquidity. Business that are unable to pay their debt can use this process to renegotiate the terms of repayment. They can keep things running by restructuring. Okay, now we go discussion about the integration of tax effect and financial cost distress. Okay. Modigliani and Miller suggest that company value increases with leverage when considering corporate taxes. However, this theory overlooks the complexity of real-world decision-making, as it assumes that all companies should always choose maximum debt. Some researchers propose that the expenses associated with bankruptcy and other related costs may diminish the value of a leveraged company. Now we look at the graph. In the graph, the first value in a world without bankruptcy cost is represented by a diagonal straight line. The worth of the company with the expenses is shown by the O-shaped curve. When a company transitions from being entirely equity to having some debt, the O-shaped curve rises. Due to extremely low likelihood of distress, the present value of the associated cost is negligible in these cases. But the present value of the expenses increase faster as more debt is incurred. The present value of the debt should eventually increase to equal the increase in the present value of this cost resulting from an extra dollar of debt. The amount of debt that maximizes the firm's value is indicated by the B. Put differently, the ideal debt load is B. Beyond this point, the tax shield is outpaced by the cost of bankruptcy, suggesting that additional leverage will reduce the firm's value. Okay. Agency cost of equity occurs when there is a conflict of interest between management and shareholder. This conflict arises when management makes decisions that shareholders believe will not increase the value of their share. For instance, management may decide to pursue a merger that shareholders do not agree with, leading to agency costs like lobbying expenses to prevent the merger. Okay, now we will be discussing about pecking order theory, also known as the capital structure pecking order. According to the pecking order theory, companies follow a hierarchy when making decisions about their capital structure. Internal financing for the first, internal financing or retained earnings. Companies would much rather finance new initiative and investment with the money they generate internally. They are able to avoid recurring outside funding, which would have resulted in extra transaction expenses. It is also convenient because the company can obtain permission without going through external investors, bank or institution. Okay, second, debt. If a company does not have enough internal financing, it may choose to raise debt through various means such as using available credit lines, obtaining new loans from banks, or issue a different type of bond. Opting for debt instead of issuing new equity allows companies to secure funding without relinquishing ownership or control. Okay. Last option, issuing a new equity is seen as a last resort in this pecking order. This can dilute ownership and requires sharing control with new shareholder. So for this step, we must choose internal financing for the first. If we cannot, then we choose that, and if cannot, then we can choose the equity. Okay, so why we have the hierarchy? For some reasons, the first reason for the information asymmetry. Companies usually know more about their risk and prospect than do outside investors. Since a company usually issue new equity when markets are doing well and stock prices are relatively high, this could be interpreted by outside investors as an indication that the company thinks its stock is overvalued. The share price may be harmed simply by a company announcement that it is raising equity. Okay, second reason is the transaction cost. There are transaction costs involved in issuing new debt or equity when relying on internal financing. Debt issuance generally carries lower flotation costs when compared to equity. Third reason, control and ownership dilution. Companies can avoid dilution of ownership by using debt of internal fund. A larger group of shareholders may require management to answer in an event that new equity is issued, which could dilute the control currently held by the existing shareholder. Business run by families are especially cautious when it comes to adding new investors. The fourth reason, cost of the finance. With scheduled principal and interest repayment, debt is essentially less risky for investors than equity and has priority over equity in the event of liquidation. To make it even less expensive, it could also secure against company assets. Moreover, debt is a desirable option when it comes to taxes because interest payment or debt are deductible. Such tax benefits are not provided by the equity. Okay, so there has been some benefits if we are using the pecking order theory. The first one, we can avoid loss of control and dilution by using internal fund that allows firm to maintain existing ownership and control structure. Second, we can reduce financing costs. Internal fund and debt are typically cheaper sources than equity financing. Second, flexibility for future investment. Using less debt preserve borrowing capacity for future need. And the last one, reduce information asymmetry. Debt requires sharing less private data than issuing equity. Okay, however, there also has been some limitation by this pecking order theory. The first one, oversimplify complex decision. A rigid hierarchy fail to capture real-world factors that affect capital structure. Second, applicable mainly to established public firms. Less mature or private firms often lack access to a cheaper internal and debt financing. Next, ignore benefits of equity. Firms may issue equity to strategically align with investors or when shares are overvalued. Static view, changing market conditions affect the relative cost of debt and equity over time. Okay. By using internal fund could cause a company dividend pattern to change. The pecking order theory may be applied erroneously, which could result in lower dividends and harm the share price, which is preferred by many equity investors who value dividend reliability. Okay. As a conclusion, although the pecking order theory is a helpful starting point, it tends to oversimplify the complexity of financing decisions. In reality, there are numerous factors besides cost and control that influence the ideal capital structure. Companies must consider a variety of trade-offs based on their circumstances, such as their funding requirements, the purpose of the capital, their current level of leverage, and other pertinent factors. Okay, for the last one, we will be discussing signaling hypothesis. Okay, the idea that many actions of economic actors are primarily motivated by the desire to send a positive signal to other actors rather than their apparent purpose. This can be a way to solve the asymmetric information problem between transactions. For example, a company may decide to spend a lot of money advertising a new product, not because it is the most cost-effective way to advertise, but because the company large investment show investors its confidence in the product, distributor, and other stakeholders. Similarly, a generous dividend policy can be a means by which management expresses to financial market its positive view of the company position and future prospect. In this case, such signaling is a means to eliminate the conflict between information available to managers and information available to shareholders. The signaling hypothesis is the belief that information about the financial condition of the company is not available to all market participants at the same time, because managers and board members have more information about their company prospect than the general public. The decision they make can reveal information about the company finance. Dividend or stock buyback may indicate that a company management expect future growth, while stock or debt issue may be less favorable. Okay, that's all from me. Okay, thank you very much for listening. Have a great day.